Okay, so in this video what I'm going to do is take you through the weekly macro themes report. We're going to specifically look at one particular idea, which is value versus growth. So the weekly macro themes report is our core flagship report of the institutional service each week on a Friday, New Zealand time. We go through 5 different topics, and it can be ranging from sort of broader macro trends and themes, such as, for example, that first one, or it can be specific ideas, specific things that are going on in markets or asset classes, and that can be either from an investment idea standpoint or sort of a risk flag, risk management input standpoint. But anyway, we're going to focus in on value versus growth in this video, and so we'll just jump straight down to that topic. Here we go. So probably the most interesting chart for value versus growth, or certainly the one that brings it into attention, is that first one there. And so that's showing you the S&P 500 value index versus the S&P 500 growth index, and it's just their relative price performance across that period there. And you can see there that value is trading at an all-time low versus growth, and that there has been this sort of interesting and fairly noticeable downward trend across, or at least from the 70s down to the present. And I was going to say consistent, but it's really not that consistent because there's been some quite wild gyrations around that trend. So, for instance, the last time that we saw such substantial underperformance by value or outperformance by growth was into the 2000 dot-com bubble, and then they unwind from that. So there was that. This first phase here is what you would call, consolation prize performance, and that's where value fell less than growth. Meanwhile, the second wave there was more of a virtuous outperformance where both value and growth were rising, but value was outperforming. And so, looking into this period now, again, we could easily see a repeat of that kind of scenario where, excessively overvalued growth takes a tumble, and probably that would end up taking the whole market down, and value would arguably potentially fall less. Now, just on that second chart on there, so it's both the same thing and a different thing. So it's showing you the same thing in that it's also the S&P value versus growth index relative performance, but at this time it's in total return, because that's, if you just show price only, then the common sort of objection or concern would be that, what about the total return? Because, as investors, you get the total return. You can see there that it's not as dramatic. It's not a clear, sort of one-way trend there. It's more of a range, which is probably even more interesting. That one actually looks a little bit more mean reverting, whereas the one on the left is probably a bit more trend reverting rather than mean reverting. But one of the big things, and pretty much in line with those two previous charts, is the relative valuation picture. Now, this chart here on the bottom left is strictly speaking, that's not value versus growth, but what that actually is the valuation discount between the lower and the upper quartiles across the different industries of the S&P 500. So it's the cheaper industries versus the more expensive industries, and you can see that the cheaper ones are more cheaper than usual versus the more expensive ones. And it's from that kind of scenario where you do tend to see, certainly over more of a medium to longer term time frame, turnaround in relative performance. And I do want to go into valuations a little bit deeper in a second, but first of all, we'll have a look at the sector breakdown of certainly at least the recent performance here. And so you can see here on the top one, these are some of the big sectors where growth is kind of overrepresented. And so, for example, information technology is a big one, obviously, and then consumer discretionary and consumer services. And notably, there was a bit of a shake-up in some of the classifications. And so, if you looked at some of the big components across these, you'd be finding that it's basically big tech. And but anyway, the bottom line is that, if we look at that particular lurch down in value versus growth recently, a big part of that can be, on the growth side of thing, explained by the run in tech, which, tech has had a very good time during the pandemic because, tech has been, the pandemic's really accelerated a bunch of existing trends. I wonder a little bit, though, whether it's brought forward a bit of growth, and so you basically had the market factoring in the fact that it has, kind of brought forward that growth. If that, theory or idea was true, then that would definitely have some implications for forward-looking returns. Looking over to value, some of the sectors that are kind of overrepresented in value, certainly energy, financials, utilities, healthcare, consumer staples are among those. But probably, certainly at least the ones that have really contributed to the underperformance of value. So, it's actually both sides of the coin here. So you've had tech performing very well, but then you've had energy and financials performing quite dismally. And that's really been the major driver of that really sharp lurch down in value versus growth. And so really then, if we just distill it down to sort of the major chunks or the big drivers, it's really just going to be those three things. It's going to be energy and financials on the value side and tech on the growth side. And so if we zero in on energy and financials, I think these two charts are really quite informative for value versus growth and for these particular sectors, but definitely these two, I think, hold the key for making some sort of assertion or expectation about long-term expectations around value versus growth. So let's just go through these. The energy sector valuations chart on the left there, the black line is absolute valuations. So this is a combination of price to book and price to dividends, so the inverse of the dividend yield. And it's the historical Z-score of that, so how it's tracking versus history. And you can see there that it briefly got to a record low, at least in the history that we have, and currently is still tracking over one standard deviation cheap versus long-term average. And then you look at the relative value picture there. So that's, again, the same metrics and a Z-score approach as well against the S&P 500. And it's basically 4 standard deviations below long-term average, i.e. extremely cheap. So whether you look at it by itself or against its own history or against the S&P 500, very cheap valuations for the energy sector. And for financials, it's actually quite a similar picture there. Absolute valuations, and so just briefly in passing, I've also brought the PE10 ratio into the picture here. And so that absolute valuation picture is, it's basically in line with long-term average. It did briefly get quite cheap there during the March sell-off, but you look at that, if you just looked at it from sort of 85, you'd say that that's quite reasonable valuations there. Certainly not expensive. And then if you look at it relative to the rest of the market, so relative to non-financial stocks, you can see there that it's basically at a record low. You have to go back to the dot-com bubble to find such attractive relative valuations for the financial sector. So, if you look at the two sort of major underperformers for value, these are also the basically the cheapest. They look very attractive, certainly on a relative value standpoint. But, valuation is not the only thing that you can look at, because, if you think about valuations, we can just briefly look there. Before the oil crash, you would have been looking at energy and saying, oh, well, energy looks fairly cheap at that point. So you need some sort of macro catalysts really to just really kick things along. And so where could you get those? Well, ideally, if crude oil were able to at least hold on to that rebound, or ideally climb a bit more, that would help energy stocks. And then on the financials, the relative performance of financials versus S&P has been fairly closely linked to 10-year bond yields. And so that's obviously linked to bond yields in and of themselves, but it's also linked to what bond yields represent in terms of, an economy that's doing better. So, but basically lower bond yields reflect weaker growth and inflation expectations. And so if you started to get a situation where the market was factoring in expectations around better growth, better inflation outlook, and personally I think that will probably start to think more and more about that as the year goes on, as the stimulus measures pick up. If you get some sort of normalization, some sort of reopening, and then you pour all this extra stimulus onto it, to me that's a recipe for upside overshoot, for growth, or certainly at least a rebound in growth, and brings into the picture inflation as well. And then on the tech side, you can see there that it's getting quite frothy. So we've got on the bottom panel there of that chart quarterly flows, and so you can see that the flows have basically gone ballistic, and the ETF market share, so basically allocations to tech, are at a record high. And so, really you do need to see, I think, probably a turn in bond yields, stable or improving commodity prices, generally just a better macro outlook. It's interesting, tech's usually dumped in as a cyclical sector, but really it's acted as basically a defensive sector for this thing that we've been through. And I think, going out the other side, looking forward, value versus growth is going to be one of those areas that's going to particularly benefit from normalization, from opening up, and from any possible overstimulating of economies that results from really the historic, globally coordinated across fiscal and monetary policy, just that historic stimulus that has been poured into the system. Yes, and now I get it, that short term, some of the transmission channels of stimulus have been impaired, and certainly you could call some of the stimulus measures just simply life support measures, but I think that looking further out, we are going to see better growth ahead, and that's going to be higher bond yields, higher energy prices. That's going to be good for very cheap energy and financials. And if tech sector has already factored in a lot of future growth, if we've had this pulling forward of growth, then that's going to constrain things on the tech side. And I haven't shown it here, but tech valuations are very high, very lofty, and so that kind of puts the odds against them over the medium term. So yes, if we go back to the sort of starting page here, looking for a combination of better performance from energy and financials and worse performance by tech to drive a turnaround in value versus growth. And it's basically one of our higher conviction calls over the medium term. So, certainly over a 3 to 5 year time frame. And shorter term, we just need to see a turn in those macro catalysts to drive a turnaround here. So, look, if you found this video interesting, definitely don't forget to subscribe to the channel, but also you probably want to check out the website. You can see there, topdowncharts.com. And if you are working as a portfolio manager, or if you're in the industry, you'll probably want to check out this service, get these reports on an ongoing basis.